So first up today, we have a keynote presentation from Shaw and Partners CIO, Martin Crabtree. Martin, welcome back to the network. Please take it away.
Thank you for adding tree to my surname there, Paul. So it's Martin Crabb.
Oh, sorry. I do apologise.
It's all good. I've been called worse. Thank you, Paul, and welcome everyone to today's call. Good morning or good afternoon, depending on where you are in Australia or around the world. So I'm the Chief Investment Officer here at Shaw and Partners. We're one of Australia's leading wealth management businesses, and if you've got some money to invest, come and talk to us and we'll help you out. So I'm just going to spend 5 or 10 minutes just running through, I suppose, the macro environment, how we're seeing things at the moment, and just to paint a little bit of a picture of investment markets, and when is the right time to put your sails up and lean into the risk on market that seem to be arriving. So when we're looking at framing the investment outlook for clients, we've got a process that we've followed since I've been running portfolios here at Shaw and Partners for over a decade. We run a couple of $1 billion in portfolios on behalf of clients. We make the investment decisions on their behalf. So I'll just give you an insight as to how we're thinking about markets and how we're investing those monies as potentially some ideas and guides for investing your own money, including looking at some interesting businesses in the battery raw material space, which we think is a really interesting, emerging and exciting area of the market. So you're going to hear for some great companies in that space shortly. But just to set the scene, so the things we look at are growth, financial conditions, and central bank positioning. And we probably also have one eye on valuation, both relative and absolute valuation. So if I can just sort of step through those, it'll give you a bit of an insight into our thinking. So firstly, on growth, are economies expanding or are they contracting? And more importantly, what is the direction? So are they contracting faster, contracting slower, expanding faster, expanding slower? One of the measures we look at is the OECD Composite Leading Indicator. So it's not an investment bank, so it doesn't have any bias. It's done by the OECD, which is a supranational organization based in Geneva. And they've been doing composite leading indicator analysis for major economies for decades. So there's a really rich data source, which for data nerds like me is great because you can do a lot of back testing on this composite leading indicator and how successful it is at predicting the economy. So it looks at a range of measures, looking at credit, risk, equities, a whole bunch of measures, and predicts where economies are going to go in 6 to 9 months. It's not 100% accurate, nothing is, but it's a good guidance as to the pulse of growth. Now, they released their numbers on the weekend, so they're relatively up to date as of the end of October, and they show an expanding global economy. So it's above 100, the indicator's above 100, which means that economies on net are expanding. And it's really being driven by China and to a lesser extent the United States. So there are signs of life in the US. Some of the credit spreads are starting to come down. Some financial conditions are loosening, and the Fed's talked about that. And there's also probably signs that the Fed is close to being done on interest rate rises. So some market rates of interest, like long bond yields, for example, have started to come down. So on the growth front, globally, things are improving. Not the case in Australia. The Australian Composite Leading Indicator is still negative, so it's still below 50 or below 100, sorry. So contracting, but also still slowing down. So it looks like the outlook for the domestic economy is continuing to soften, and that's probably not a surprise to those who follow the interest rates. And obviously, interest rates have been hiked again recently. So the picture for the domestic economy is not good. The picture for the global economy is positive, driven mostly by China, but also some signs of life in the US. So that's a tick in the asset allocation box. The next factor we look at is financial conditions, and I kind of referred to them a little bit already. How easy is it to get finance, and how expensive is it going to cost you to get finance? So if we roll back to 2021, when the governments were printing money, anyone could get a loan, anyone with a pulse could get a loan, and it really didn't cost you a lot of money. So in Australia, you could lock in a 3 or 4 year fixed rate mortgage with a 2 handle. That same loan today, if you go down to the Commonwealth Bank, your local branch, and ask for a loan, it's more difficult to get. So you need to have more income, more assets. You need to be a better quality credit to get a loan. And if you do get a loan, that same loan is probably going to cost you 6% today. So we've seen almost a tripling in interest rate costs in Australia. That's classic financial condition tightening. We're still seeing financial conditions being very tight, but they do seem to be loosening a little bit. So there's a number of measures that we look at for financial conditions. Probably the most famous is the Chicago Fed, who produce a financial conditions index weekly in the United States. It's got about 150 measures in it, so it's very complicated, but it does show signs that financial conditions, although still tight, are starting to loosen. So the purse strings at your local branch just starting to loosen up a bit, less so in Australia. Financial conditions are still pretty tight in Australia, but globally they seem to be loosening. So it's still tight, but it's starting to improve this. So that's another tick. The last thing really is looking at central bank positioning. So every country has a central bank. Most of them are independent, with the exception probably the Bank of China, People's Bank of China, which is still controlled by the government. But in most countries, the central bank is independent and has a dual mandate to create price stability / cut inflation and maintain full employment. So full employment, minimum inflation is kind of the target. Now, most central banks have that target. Most of them have got a number. Australia's 2 to 3% inflation. The US is 2%. Most central banks are looking at 2% inflation, and we're not there yet, right? So we've got inflation coming down, but it's not at 2 or 2.2 to 3 in Australia. We're still looking at 4s and 5s, and in some countries even higher levels of inflation. So the job is not done, and all the central banks have been saying that. Some have been moderating their language around that, but there are still signs of inflation. And in Australia, the situation is probably a little bit worse on that front than it is in the US, for example. So wages are still going up. The latest wage data out this week saw a 4% increase in wages, and that's going to keep going up because next month it's going to be 4.2. So wages are rising, and also house prices have recovered. So we saw a sell-off in house prices last year. This year, they're probably up 10%. That's going to flow through to higher rents and higher purchase costs for new homeowners, and they're big parts of the CPI basket. So the Reserve Bank's got more work to do, whether that's higher rates or whether that's rates staying higher for longer. Those conditions are not particularly positive for equity markets, and those businesses that rely on debt are going to be paying higher interest rates on that debt going forward. So that's the cross, if you like. If there's two ticks being improving financial conditions and improving growth outlook, the cross is that central banks are not yet done. So until that box is checked as a tick, we're neutral on our asset allocation. So what does that mean? Typically we run 70-30 portfolios, being 70% growth assets and 30% conservative assets for portfolios. We're sitting at 70-30. Last year we were more defensive. We had more bonds and more hybrids and less equities. This year we're pretty much neutral. If we see signs that the central banks are done, that inflation's down to target and central banks can start cutting rates, that's when we can become more aggressive. Just on one thing on small caps. So small caps have underperformed large caps by a lot, and it's not just in Australia, it's a global phenomenon. There's been a flight to a very small number of very large businesses, and so the small cap relative to large cap valuation is kind of screaming a buy at the moment. So we think there's some really good value in the small and micro cap end of the market. It is a stock pickers area, so you need to do your research, which is a standard disclaimer. So do your research, but companies like the ones you're going to hear about today are exactly where investors should be looking for returns going forward. So that's a bit of a wrap from me, Paul. I might hand it back to you. Thank you.
Thanks, Martin. As always, really appreciate your views on the market. Look, yeah, you kind of touch in there that you don't think that the Fed is quite done yet. Bringing that back into sort of the marketplace, if you look at globally, the amount of new companies that are listed this year, IPOs are at record lows for the last 20 years. One of the big issues, I guess, for small caps is capital markets have also been pretty much closed. When do you think we're going to start? When do those doors start opening? Is that a first quarter next year, or do you think it's more of a second quarter when we get more direction from the Fed?
Yeah, I think the consensus view, Paul, is that you wait until the first interest rate cut, and then it's all bets are on, right? So that's every IPO will be rushing to the market, because people will start investing, they'll start taking risk once they can see that interest rates are starting to come down. So the first cut in interest rates. So we're saying to investors that are looking to raise capital, don't wait for that moment, because you'll get run over. If you need the capital now, we can probably get it for you. The pricing's obviously an issue, as you said. The markets are open. Steadfast have raised Karoon Gas has raised, Peninsula Energy. We had 3 capital raisings yesterday. So the markets are open. It's that the pricing is probably not as attractive. But in terms of the time to flick the switch, now is a good time as any to put money to work. We should be fully invested. But in terms of going overweight and being even more positive in your outlook, I think the first interest rate cut we'll probably see in the second half of next year.
Martin Crabb, many thanks for your time today.
Thank you.